All right, everyone. So, welcome. Thanks a lot for showing up. This is another one of our events here at the FPA Miami. What we've tried to do really recently is we're really pivoting all of our content to go online. It's actually very, it's wonderful. It's kind of easy. It's something we've always wanted to do, but no one really got around to it, and now we have to, and but it's working out. It's working out well. So this particular presentation is part of our practice management, group. And so I see a lot of people that are here have attended in the past and are potentially, familiar with this format. But really what it is more so than being a talking at, it's a talking with type of format. And we have our wonderful panelists here. And usually how the format goes is we will have them speak, present, talk about, the topic that they're going to talk about. And then really for potentially almost half the time or the like, we try to have a conversation, to really open up about what we're talking about, as open, honest as everyone might want to be, that'd be great. So what we're trying to do a little differently here is that I'm going to be muted while they're presenting. And really, if everyone has questions or comments and the like, please put it in the chat box. And I will stop them and maybe at certain times and we'll ask those questions, or they may see it in the chat box themselves to try to simulate that conversation. So I'm going to try to moderate and facilitate in that way. Now, if someone has really, more of a nuanced question, I think there's ability, maybe I can allow them to speak and the like. Yes, I have that functionality. So we'll go through there, but please be as active as you'd like in the chat. We really want everyone to to get as much out of this as they can. So basically what this presentation is about is about business models and compliance practices, simplified, demystified. This is something that's personally means a lot, near and dear to me. A lot of my journey as an advisor. This last year, I moved from being an independent broker dealer to being my own RIA, and really, for many people, I know it's very daunting, it's very confusing, it's very uncertain of why you would do that. And so here at the FPA Miami, we're not trying to advocate one practice model over the other. Everyone needs to find their own route. But what the hopes of this meetings and future ones would be, it's really understanding each model better, just to make sure that you feel like you're in the one you want to be in, and that makes sense to you, and all the like. So we have two wonderful presenters. I will let them speak here shortly. The majority of the introduction is going to be by Cami. You're going to see why. And then Tanya will chime in on the legal side and some comments on it. And like I said, please be active with the chat, and then we'll open up the conversation. So without further ado, I will pass this over to Cami.
Thanks, Steve, so much for the introduction. Hi, everyone. I'm Cami Smith, the owner and founder of Revive Consulting Plus, and it's a pleasure to be here this morning with the FPA Miami alongside Steve and Tanya. So we're really excited about the just kind of educational time that we have together, and just some open dialogue about, particularly in this session, different business structures and affiliation models, and what they are, how things have changed over the past, 20, 10 years and going into the future, and maybe why it's relevant now, and maybe even more so with COVID to explore these various models. So I am going to share my screen with you now. It's going to take me just 1 second to get it uploaded here. And we'll just walk through, maybe for the next 8 minutes or so, kind of just a little bit of background on what these various structures are, because I think there's a lot of information out there, and it's difficult to know what makes sense for what type of an advisor and why. Okay. So here, just 1 second. Okay. Excuse me while I get this started. Oops. Okay, perfect. So again, my name is Cami Smith, and I'm originally from Minnesota. I'm a Miami transplant as of about 4 years ago. Prior to Miami, I actually was a financial advisor for 8 years in an independent firm in Minnesota, and then I went to Madrid and got my MBA from IE Business School. It's a globally ranked international MBA. Speak Spanish, a couple languages. So for me, that was really interesting to get a broad perspective on business and life. And coming out of business school is kind of the classic, couldn't find a job I liked, so I decided to design the one that I wanted to have. And what I noticed was that there was a lot of kind of trends affecting the financial services industry, and particularly in the private wealth management sector. And I found it really interesting that there's going to be a lot of advisors needing to retire and figure out how to do that, in the next 10 years. Secondly, there's a lot of trends happening in terms of technology improvement and the velocity of change in technology and how that's affected kind of the entire value chain in financial advisory services. The third thing that I noticed was, while clients are demanding like an unbiased and advice-driven business model, nobody's taking care of the advisors. And so for me, that was really motivating to say, how can I help the financial advisors, especially teams and firms, really understand kind of what their business is, where they might need to go for the future. And really, instead of kind of looking at it from just a practice standpoint, financial advisors tend to be really, really great practitioners, and all of a sudden they have these large businesses that don't have professional management. So how can I help them, and how can we help them in that way? And so essentially that's what Revive has set out to do. We help advisors prepare for retirement or succession, and our lens is that we like to do that 5 to 7 years in advance to get them on that path, because what they're trying to do is sell a predictable revenue stream based upon a relationship. So that's different than many other industries or sectors. By way of doing that, we might also look and say, how can we take your traditional values and modernize your technology workflows? As things have evolved, there's kind of the sentiment of better, faster, cheaper. And I think a lot of advisors don't know really what's out there or what that means in terms of integration with CRM, financial planning system, workflows, all these things. And if we grow a little bit along the way, then that's kind of an added bonus. And I think the third thing that's really come about in the past 3 years that most clients now are asking us to help them with is just to understand the ecosystem. What are the different affiliation models? What are the various channels? How does that mean for the financial advisor and his or her practice on the way to becoming a business? And how does that impact their clients? Or maybe they were very transaction focused back in the 90s. Now they're very, fee based. What does that mean? And I think also in particular why this is interesting for FPA advisors is because all of the FPA advisors, or many of them, as we know, are very planning centric and advice centric. And those are kind of the ones that I have, passion for, since I started in a very planning centric firm back in 2007. So in particular, these type of advisors, I think, have special opportunities that they may want to consider. And so that's why Steve asked us to kind of present today. So now we're going to go through just some things about the industry and kind of take just an educational moment to make sure that we have a shared language on some of the concepts that we'll use throughout the rest of the discussion. And I'm really excited for my colleague Tanya to also chime in and talk about some of the legal aspects, what we want to be considering well in advance of any kind of change or due diligence that an advisor might want to do, and then well into actually operating in whatever environment the advisor chooses. And I think, as Steve mentioned, this is near and dear to him because he just has gone on this journey himself. So he decided, did the education due diligence, and decided that for his clients and for his practice now becoming a business, he wasn't in the right environment. And so I think he'll be excited to kind of bring some examples and elements to life as we go through this, as I will share about various clients that I've worked with. So why now? Why are we talking about this now? Well, one reason we're talking about this now is just because of those macroeconomic things that are happening in the world and affecting our sector in wealth management. And that will continue to happen. And for me, I think that the rate of change will, especially because of technology, will continue to advance quickly. I think the second main reason why we think this is relevant now, and maybe we'll do kind of a series if people are interested, is that how has COVID affected financial advisors and what this means? And as I'm talking with financial advisors out there, a lot of them now, as the dust is settling a little bit, I don't think we're out of the trenches, but at least the major volatility of March has settled a bit. Many of them are asking, okay, so next time. Am I in the right environment? Is there a better way to do this? How come my broker dealer isn't helping? What am I paying them for again? How do I manage some of the fixed costs? So I think all of those questions are starting to percolate. And so that's why we're having this conversation. Okay, so let's see here. So just to kind of frame up wealth management, there's about, studies show 330,000 financial advisors in the US across various channels. And we'll talk about that in just one moment. There's about 86,000 CFP professionals, again, the ones that are near and dear to my heart, financial planning focused, and centric, advice centric. And so those ones in particular, I think might have, the CFPs and FPA members might have special opportunities that they want to look at. And just so we also understand context, last year in 2019 and again in 2018, almost 9% of advisors went independent or made a transition in their back office support, the broker dealer. So that's like 27,000 advisors. And I just find that number astronomical. So this is exactly why we're having this conversation. Okay, so the value chain of our industry. So I thought I would just lay this out there in terms of who are the different players and in what order do we call this our value chain. So if we start at the bottom and think about our end clients, right? Our end clients are the ones that rely on financial advisors or some sort of format to give them advice and potentially access investment products. And this is really different when we think about the evolution. So back in the 80s and 90s, financial advisors were in brokerage formats because literally clients had to access investments through them. There wasn't a way to just go on E-Trade or Vanguard or DIY, didn't exist back then. Literally, they relied on financial advisors to get them products. And so I think just understanding, like historically, like, that's an interesting, kind of shift in the value chain is interesting. Going up from end clients, and you have advisors who are affiliated with registered investment advisors, wirehouses, captive environments, independent broker dealers. And the purpose of the independent broker dealers, wirehouses, RIA, it's all a little bit different. We'll get to that in a minute. But one of the main offerings that the IBDs and wirehouses provide is a compliance oversight function, right? And maybe some other services along the way that differentiate them. And maybe that gets lost a little bit. Whereas on the RIA side, we have to find a different way to find their compliance oversight. Next, then we have our custodians. So we're all probably familiar with our custodians. Some of the big ones in the independent space, the registered investment advisor space, are obviously Fidelity, TD, Schwab, potentially TD and Schwab have a deal on the way. Then those are kind of the big three. Then there's tiers going down from there in terms of middle, small. On the independent broker dealer side, because of the historical relationships, probably the two main players are Pershing and NFS. NFS is a subsidiary of Fidelity. And then finally, we have the asset managers who supply product, right? So we can think about these as any of the big asset managers out there. And so I bring up Vanguard and the like. So DFA, Fidelity, American Funds, we can go on. So I bring this up in terms of the value chain so we understand in what order things go. And I think what's really interesting is really because of technology that has changed consumer preference and behavior, the way that we can access this value chain now really becomes a web versus just a value chain. And so also how we have to think about that is our favorite topic, fee compression and margins. So as advisors, we're on one side of that is, are we accepting the fees or are we passing them along to our consumer? But that's happening all along the way. And those will continue to shrink over time, basically because of technology. Technology has made asset management better, faster, cheaper. And so maybe some of the duties that we needed in the past just aren't relevant anymore. And so when I have advisors come to me and say, well, what do I need? Basically, I ask a very open-ended question as we also get to know their clients' business mix, kind of their story of their practice. But what do I need in a back office partner and how do I want to pay for it? And from there, then we get the preference of kind of which affiliation model might make sense. Okay, so here I think is maybe the most interesting slide that we're going to talk about right now today. And I wanted to walk through then just the various channels in terms of on a spectrum of least independence to most independent. So, okay, and Okay, perfect. Okay, so I see a polls up on the screen. That must have been Steve just working this out. So Steve just said, of the business models presented by Cami, how many of those have worked during your career? So, which is perfect. Okay, so back to the slide then about on the spectrum of least independence to most independent. So probably the bookends, right? The most independence, pure RIA, and the least independence, the wirehouse channels or captive environments are most familiar to most of us. So starting from the least independence, we're very familiar with the big BDs, big broker dealers, and maybe some of the captive insurance environments as well as being W-2 models, typically in those channels. Advisors are typically maybe employees of those channels. And essentially in these environments, the BDs or the captive environments take on a lot of the risk, but also supply support for some of those channels. And maybe they have access to, their investment managers themselves. They might have custodians that are vertically integrated, so they have their own custodians in that channel. But basically, in those environments, we think of advisors as employees of those firms. They use the branding, the employee, they might be paid a salary that's based upon, lower level payouts. That's kind of the characteristics of the wirehouse channel. On the other side of the spectrum, we have the pure RIAs. So like what Steve just did, he literally owns his own business and has his own registered investment advisor or RIA, for which he places all his business. So this is the most entrepreneurial. He absorbs the most risk in theory. He can have his own business and practice. He collects 100% of his revenue and then decides from there how he pays for it. He probably employs some sort of compliance operations consultant, which I know that he does, to get those different services. He can have total flexibility of what investment products he wants to use, how he charges clients for advice. But also to note on that side, on the pure RIA side, he probably doesn't do any transaction business or variable annuity. So he has no need for FINRA registrations on this side. And there's ways to form what we call a hybrid. We'll go into that in a future setting. But basically what he's decided is that he's fee only. He controls 100% of his business, absorbs 100% of the risk, is flexible to make decisions, and then brings in experts just like we do for our own legal and accounting in our business with compliance to help them. In the middle, then we have the IBD, the independent broker dealers. And basically the independent broker dealers, there's a lot of them in the industry. We see a lot of consolidation happening, particularly after you get to basically the size of like the 20 largest by revenue. And that makes sense. Cost, right? Economies of scale. Like it's very hard to maintain an independent broker business deal, independent broker dealer business these days, even if you do have an RIA affiliation. Because there's a lot of cost to the transactions, cost to technology. You're trying to service a network of advisors. But on that side of the coin, there's kind of a distinction I'd like to make between the IBDs and quasi-independents. I think this is one of the huge opportunities that advisors should know about. So in my mind, what differentiates the true independent broker dealers that may also have an RIA affiliation, and RJFS is one of them. So the Raymond James Financial Services of their various models. We're talking Commonwealth, we're talking Cambridge, we're talking Kestra, we're talking some of those firms. Their contracts literally say that the advisors own their clients in their contracts, and they're there to provide a service in terms of compliance, maybe some back office and middle office services, some things there, but that's a huge distinction. The quasi-independent, I'm going to call them, are maybe what advisors aren't as familiar with is there's a lot of independent broker dealers out there that are attached to another business, and the independent broker dealers in this kind of, I would say, channel or category would tell their advisors that they're independent, but when you actually read through the contracts, they may not be. They may not own their clients, right? They may have to sell one product over the other, so it's not really, out of my mind, a fiduciary. Or how do you act in a fiduciary capacity when you have that? And so I think that's a really interesting channel and kind of place to look at your contracts and read. Because as we're thinking about growing a business succession, one of the questions I ask is, how do you build true value? And that's through owning your clients. Now, going back to, I would say, the circle number 2, in between pure RIA and IBD, one of the most interesting kind of services that is coming about is the RA service providers. And the RA service providers are literally service advisors. I would call them outsourced back and middle office solutions. So maybe I'm an independent advisor, or we have an independent advisory firm. It's Cami and Associates, LLC. We have our own RA, Cami and Associates LLC. And basically, I just choose. I don't want to have to worry about my compliance. I need outsourced financial planning. I need someone to help me with marketing. So my preference is I'll just pay them to do some of those things as a percentage of my revenue, or whatever the deal might be, to provide those services in-house, or all streamlined in one. Okay, so that was a lot of questions. I'm going to go back to the poll now. So again, of the business models presented by Cami, how many of these have you worked in during your career? And it looks like about 30% have said 1, about 50% have said 2, 3, 20% have said 3, and too many to count. So it looks like most of us have worked in either 1 or 2. Some of us have worked in 3. I'm going to share those results. Okay, so then the point of this slide is to next talk about, now in the RIA world, since we've been around for 20 years and there's different preferences among advisors about how they want to run their business. There's many different ways to run their business in the RIA side. So I'm just going to move on from this slide today, but I think in the future, or if we have questions, we can come back to this. But I think it's worth mentioning that there's a lot of now platforms and services out there for RIA advisors. Whether you'd want to join a firm and tuck in, you can start a branch office. There's platforms called aggregators, that would be kind of like the roll-up world that we've talked about. So we'll come back to this slide, but I did want to mention that even if you think that RA is the model for you, you want to own your clients and have your own business structure, there might be different ways that you can nuance there. Okay, and just to frame up, before I move it over to Tanya, I thought this slide from Fidelity, this is back actually like a 2015 slide, and it said the industry outlook in, I think, 2025 or 2026. And I thought it was very interesting to kind of frame up. So we know where we've been, we know where we are, where are we going, and why does this make a difference for advisors to evaluate today? And I thought that this is a very interesting slide to talk about the large BDs, the large RIAs, and local players. And essentially, what Fidelity is saying is that, some of the BDs out there are going to continue to go more niche and focus on a particular type of client and a particular type of advisor, because they're realizing that they can't serve all advisors in this environment with all the compliance structure. I mean, look, you had, the Mass Fiduciary come out, Reg BI. It's just too much to try to cater to so many different types of advisors and therefore their end clients. And so they'll probably be specialists in some certain market. And so they'll look for their target market in there, whether it's an insurance company, one of the big BDs, they'll all start to be kind of known for something. And so, and the pricing will impact advisors on what they actually pay and get. And on the other side with the RIA, you'll start to see larger firms, larger independent firms. And now I believe, in my opinion, that we'll start to see even more consolidation in terms of roll-ups, interesting models like the Cap Trust model, where they kind of acquire and you can do a roll-up, or Dynasty Financial. Maybe you're independent, but you can get some kind of a capital partner to be able to grow in exchange for some ownership for them. So I think we'll start to see more there, because we're going to see a lot more succession opportunities, basically as a result of the value of the business. And for some of the independent broker dealers, I would also put them on that side, that they'll be target in whom they service, but they might start to see larger acquisitions because their advisors may start working together for succession. And then I think you'll have some of the regionals that'll just stay in the middle. So again, it's all about trade-offs. We'll go into some of your questions now about what are the pros and cons of these different things, and also what does it mean for you as an advisor, your personality, your risk tolerance, your expertise, your book of clients, your business mix. And but I think the most important thing is that this is now the time to look at some of these things. Compliance is going to keep coming down. The SEC is talking about changes on their side. So advisors are going to have to start making decisions about, it's in their best interest to start making decisions and know the playing field to make decisions about where they want to be for their clients. because there's going to continue to be a lot of change over the next 5 years. So thank you.
Thanks so much, Cami. That was awesome. That was comprehensive. I love how you put this together and how you explained it. It's just wonderful. One comment you made about when you go pure RIA, maybe you don't want to do variable annuities. Well, I will tell you, I just did my first variable annuity, only annuity, and it was the most pleasant, easy thing I've ever done. I sent all the paperwork and a statement signed by the client to Nationwide, and they took care of everything. It was unbelievable. It was unbelievable what they did there. So let me now shift over. I launched another poll there, and I know. Let me bring it up, and if anybody wants to put this one, they're anonymous. If you want to put your opinion in there, of reasons why people don't make changes, and of the specific items noted, which I thought it might be, its compliance, and for the other choices it says multiple reasons. I think compliance is probably one of them. So that leads us to our next presenter, which is Tanya Lambrecht. She will tell you a little bit about her practice. She's an attorney, and she primarily works with registered investment advisors, okay, on different aspects, and she can speak to that. And I thought it'd be helpful for her to just speak of, when you are an RIA, kind of how does it look, what's the true compliance burden, and maybe, I know it's not really in her complete exactly what she does day to day, but maybe just a comparison and contrast. How she's seen or maybe worked with, I don't think she mentioned she works with wirehouses, but maybe somewhere in the other affiliation models, and just compare and contrast those models. Thanks.
Good morning, Steve. Thank you for the opportunity of letting me do my hair today. I'm very happy about that. Cami, that was great. And hi to the rest of the FPA. Thanks for having me. So I'll tell you a little bit about myself. Steve just gave a little bit of background. I'm an attorney at the law firm of Bressler, Ambry & Ross. Locally, we have an office in Miami. I work in the Fort Lauderdale office primarily, though I'm in both offices a lot. Our firm is a full-service firm, but we're well known for our financial institutions practice group, which is the practice group I'm a part of. We call it Financial Institutions Practice Group because we really do everything for every type of financial institution, from banks, wirehouses, RIAs, et cetera, et cetera. So insurance companies, everything. So typically in past years, we've called ourselves securities lawyers, but we've just kind of expanded that definition to financial institutions. What I do, I work both on the regulatory side and the litigation side. Mostly we represent financial advisors and financial institutions in litigations when their clients sue them. We also represent, always on the defense side, always working for the financial advisor. We also represent our clients in regulatory investigations, both at the state level and the federal level. So we have a lot of experience. We see a lot of different things with a lot of different types of business models and advisors, and we've seen it all. So I'm here basically to talk a little bit about the risks associated, and really I'm going to focus on one risk associated with the different business models, and that's the litigation risk and the regulatory risk associated with them. We find that advisors are mostly concerned about those risks. Everyone's a little bit nervous about a regulator when they show up on the doorstep. And so you want to make sure that your risk tolerance is in line with that particular risk, because you could feel very comfortable in every aspect of your business, but once a regulator comes knocking, you're automatically nervous. So I'm just going to discuss each business model and the risks associated with it. We're going to talk a little bit about risk tolerance as it relates to advisors in this area. I will say the first reaction I get from advisors when I talk to them about regulatory risks and litigation risk is that the initial reaction is, it won't be me. I run a clean business. My clients would never sue me. And I wish that was the reality. We've seen everything from people's mothers suing them to people's girlfriends suing them. We've seen people who have spent a ton of time doing their own compliance, hired all the right professionals just to find out that They have so many regulatory violations that the fine is more than their firm can particularly handle. So now's the time. We have all a little bit of extra time, and this is what we see our clients doing right now, is to spend a little more time to kind of button things up. So if you haven't taken the time, and I'm especially talking to RIAs here, that's where we see most of the issues. But if you haven't taken the time to kind of review anything from your employment contract to your compliance manual to your business continuity plan, now's the time to do it. And I'm going to explain a little bit more later. But so the first thing I think all advisors should do in evaluating whether their business model is right for them is to look at their risk tolerance. We're all very familiar with risk tolerance. We deal with our clients every single day, and their risk tolerance. So advisors have the same kind of risk tolerance as well. And of course, like everything, when you weigh your risk and reward, that's how you're going to determine your particular business model. So I wanted to go through some categories that we can talk about that'll help you evaluate your risk when it comes to different business models. So, and this is what we see with our clients. So sometimes we get a client who's been doing all their own compliance, and you can tell from talking to them for the first 10 minutes that that probably wasn't the business model for them. They lacked organizational skills. They are so concerned that the regulator showed up, even though they think they were doing everything right. They just haven't focused on compliance. They have so many clients, that's the last of their problems. They want to be advising them. They don't want to be dealing with compliance. And so these are the types of things you can look at to determine whether your risk tolerance meets your business model. So one, I just kind of alluded to it, organizational skills. I think that's number one, honestly. If you're the type of advisor who hates paperwork, hates deadlines, doesn't want to keep books and records, isn't on time with filings, being a pure RIA probably isn't for you. So it goes both ways though. Yeah, you're great. Say you're a great organizer, you have everything together, but you don't have enough time to deal with all this compliance issues. Again, pure RIA probably isn't for you. Or maybe it is with the right compliance consultant. So those are the things you need to be thinking of when you think of your own personal organizational skills. The next thing is the desire to learn the compliance rules. If your reaction to the compliance rules and the regulatory rules generally is, it's interesting, rules are fun, then maybe that's a business model for you. You want to read them, you think it's interesting, you like to download that information. I'm a lawyer, so I get that. Then maybe you can do a model where you're doing your own compliance. If you want to rip your eyes out just reading the state of Florida, for instance, regulatory rules, which I do at times as well, then maybe you need to consider a business model that allows you to outsource your compliance needs, or a business model that allows you to get a really good consultant. And we'll go into those types of outsourcings. So now the third topic would be, what's your aptitude for hiring third-party advisors? When I say advisors, I mean compliance advisors, accountants, things like that. We find a lot of times that people think they can handle everything themselves. They do the best work. They don't trust anyone to look at their business and tell them what to do. If that's the case, then maybe one of those models where you have to do your own compliance is not the right model for you. And when we talk about outsourcing, just to get to that topic, there's a full range of things that advisors can do to outsource their compliance functions and their back office functions. Cami alluded to some of them in her presentation about the different business models that just have, the compliance kind of built into them based on the firm you're with. So you have the full gambit. You have straight from wirehouses who will do everything for you. to pure RIA where you're on your own and you can hire your own people, but they better be good ones. So, you know, a lot of financial advisors at wirehouses don't really realize that there are compliance consultants out there, and they range from anywhere from independent compliance consultants who have their own business and have a limited number of clients and maybe some back office support, but they do everything themselves. And then there's these somewhat large compliance companies, which have like kind of former regulators in there a lot, and they basically are one size fits all. They're pretty basic. You can pay them more to tailor your compliance, their compliance materials to your business, which is very important to the regulators, but they are available to you, and they tend to be a little bit cheaper than the typical by the hour independent compliance associate. So back to our topics. So you've decided to outsource your compliance functions, your back office functions. What's your desire to monitor those people? Now, this is really important because you can't just hire someone. The regulators say, I'm not saying, the regulators say you can't just hire someone and wipe your hands clean. I hired them to do that function, therefore I don't have to worry about anything they're doing. I would say this is the vast majority of our RIA clients in the regulatory inquiry space. So they come in, the regulator said they didn't do X, Y, and Z properly, and they look at us and they say, I hired someone to do that. It's not my fault they didn't do it properly. Well, it is. The regulators won't let you use that as an excuse for carrying out your own compliance functions. So it's always really, really important that not only you pick the right compliance consultant for you, if you're going to go that route, but you make sure that you're monitoring them to do the job from time to time. Don't expect them to call you every year, for instance, to update your ADV. You need to make the affirmative decision that every time there's a change that needs to be reported on your ADV, mind you need to know what those changes need to be, then you need to call your compliance consultants to do that. So that's really important. That's where we see a lot of regulatory issues. So if your answer to that question is, I hired someone, they should deal with it, I don't want to monitor them, I pay them good money for that, then perhaps one of these RIA models is not the model for you. Maybe you need the back office support, the full gambit of the back office support through a wirehouse, and maybe you need to pay a little more for that. You know, sometimes it makes sense to pay a little bit more on the front end than get a regulatory examination, investigation, perhaps get your license pulled, worst case scenario. But hiring a lawyer to deal with that will cost you sometimes hundreds of thousands of dollars, even if you are exonerated in the end. We just had a client, and he actually had a FINRA inquiry. They investigated him for over a year, cost him about $70,000 in legal fees just for FINRA in the end to drop the entire investigation against him, which of course was best case scenario, but this is a solo advisor. I think actually he has one other partner. $70,000 was a lot of money to him, and that's with significant hourly rate cuts that were provided to him. So, you know, would it have made sense for him to do what he needed to do on the front end to not end up in the situation he was in from his compliance issues? Yeah, it probably did. Would it have prevented it? I can't say it wouldn't have prevented the inquiry, but it would have gotten him where he needed to be a lot quicker than it did. So the next thing is sustainability. So you are doing your own compliance functions, or you've hired someone to do it. Can you sustain those functions? For instance, if you got 10 more clients tomorrow, would you be able to keep up with your compliance? If the answer is yes, absolutely, it's so important and I have the time, then you're in the right business model. But if your answer is no, my clients come first and all I need to do is advise them and compliance comes second, then maybe the business model you're in isn't right. And lastly is, if you were to get a regulatory inquiry or examination or investigation, or a client sues you tomorrow, are you ready for it? So one answer, yes, I plan for this. I make sure I have the capital set aside that if something happens like this, I can go ahead and handle it. You're the right business model. But if the answer is, I would have a total meltdown if a regulator came to my door and told me I did something wrong, or one of my clients sued me, perhaps you need a business model, maybe a wirehouse or a BD that will take care of your legal fees and hire you a lawyer and make sure you're getting hand-holding through that process. So those are kind of the things, the risk tolerance aspects that I think advisors need to determine in trying to figure out which business model is right for them, or whether they're in the right business model. And this is only with regard to one risk, the litigation and regulatory risk, which advisors tell us is, some of the most important reasons for why they choose their business model. So what's the regulatory and litigation risk associated with each model? So Cami gave us the chart with the 5 different models. I'm really going to hit the pure RIA, the IBD, and the wirehouse. And there's a mix in between, and I'll explain that. Excuse me. So pure RIA, that's where we see, unfortunately, most of the regulatory issues. Not as much of the customer complaint issues, but the regulatory issues. And that's just because sometimes advisors are just overwhelmed. They didn't hire the right consultant, if they did, or if they're trying to do it on their own, they're not doing a good job. They advise their clients first. That's what they like. That's what they care about. They're not very organized in doing it. And so that's where we find that advisors are taking too much leniency in their compliance structure and getting the regulatory dings. So the liability for the FA is, like Cami said, 100% on the FA. Of course, you can get some insurance policies, but you have to be very careful with the insurance policies that you get. There are a lot of limitations to a lot of these insurance policies. One of the big ones, of course, is it won't cover any kind of allegation, not actual finding, but an allegation of fraud, which I can tell you in the customer complaints space is one of the main allegations, no matter what you did, that a lawyer will bring against the advisor. Another limitation is sometimes these insurance policies will cap hourly rates for attorneys, which, makes sense, but the problem is usually you're confined to a small group of potential attorneys that you can pick from, and sometimes their hourly rate is low for a reason. Not always, but sometimes. So your insurance policy will control who you get to hire as your attorney in one of the most important things of your life, potentially. And then thirdly, an insurance company's goal usually is to settle the matter. So if you swear up and down that the allegations are incorrect and there's no way this guy would ever win in a FINRA arbitration, or there's no way the regulator can prove what they're trying to allege, the insurance company will settle your claim, and it's on your CRD. It's an issue you'll have to deal with down the road, potential expungement, but that's a huge issue, especially if you say don't deserve it. So the next one is IBD. This is the most wishy-washy category because there's so many different variations of your potential employment agreement or agreement with the firm. And that's really what's going to control here. So we see tons of different variations, from the advisor having 100% complete liability for any wrongdoing to the IBD taking care of everything as far as litigation, customer complaints, regulatory inquiries, and paying for that 100%. And then, of course, there's sharing of the liability, which is probably the most common we see. So maybe the IBD will front costs for litigations, but if there is some sort of settlement, or award or regulatory fine, then they'll ask the advisor to contribute. And whether the advisor contributes is up to a bunch of different things. It could be a contractual thing, it could be a goodwill thing. It's really wishy-washy on what the contribution would be in a situation like that. So the only situation you'll have there, I mean, a lot of times these IBDs, they also have their own insurance policy, so you'll have all the same issues if the insurer is involved. If they don't have their own insurance policies and they're self-insured, then usually you have to be concerned about who they pick as an attorney to represent you. And at any time, if the IBD feels that their interests are different than yours in the litigation or the regulatory inquiry, then they can drop you at a dime and you have to go get your own lawyer at your cost. So that's an issue. Lastly, wirehouse. Usually with a wirehouse model, the FA is completely indemnified, which means that no matter what regulatory inquiry or what customer complaint is filed, the wirehouse will take care of all legal fees associated with it, and then will also take care of any award payments or settlement payments or anything like that, and not ask the FA to contribute. Of course, in that business model, you're paying for that kind of insurance policy. There is some limitations to that as well. If you, for instance, commit fraud or are found to commit fraud, of course, you probably are getting fired from your job first, but second, the wirehouse has is not required to take care of your legal fees or any kind of legal issues associated with that. So those are the three different scenarios. Of course, risk and reward. So you get, you pay for some of those insurance policies depending on what kind of business model you're with. So what does this look like in the wake of COVID? Do you have the right structure for you? And so I just wanted to touch on kind of what we're seeing right now with our advisors and just kind of give some hints, our clients, and give you some feedback on what clients are doing in this atmosphere and how it relates to business models generally. So we do anticipate that we're going to see a good amount of litigation come out of the market decline, not because advisors did anything wrong. Obviously, it's very unprecedented and no one could have predicted it. But we do find that litigation just happens when people lose money. So what can you do now? You can make sure your business structure is the right business structure for you. So if knowing there might be litigations from your clients down the road, are you in the right business structure to make you feel comfortable with that risk? Yes, I have a consultant that will help me. I have a go-to attorney if one of my clients sues me. I set aside money in case anything like this ever happens. My insurance policy is great. I pay a lot of money for it. Then you might be comfortable in your business, business model structure. But if your answer is, I have none of those things, maybe I should be at a wirehouse. I can't imagine my client suing me and me having to come out of pocket for that. Maybe your business model structure isn't the right one for you. So also, what are our clients doing now on the regulatory front in this atmosphere? Like I said earlier, a lot of them are now looking at their not only their clients, but and the risk tolerance of their clients, but they're also looking at their compliance functions and making sure everything is I's dotted and T's crossed, because we think the regulators are going to come in after this. They've done it after various hurricanes and do a exam of certain advisors. So where we think regulators are going to focus, business continuity plans. If you don't have something in writing, even if it's something very one page, you're one advisor in your office, but you don't have something in writing as far as a business continuity plan, now's the time to put something together. Margin accounts. We think this is where a lot of the litigation is going to stem. Make sure your clients with margin accounts are appropriately coded. Concentration in illiquid investments. Does your client have all or a lot of their net worth in a variable annuity? make sure that you're looking at those accounts and seeing what you could do now, given that that money is kind of tied up with the fees associated. Cybersecurity. We're all working from home, or most of us. Do we have the proper cybersecurity in our homes as we do in our offices? And then can we boost up our disclosures, our risk disclosures? Did we tell our clients in paperwork that this could happen? Especially for the pure RIAs, like a lot of the, the wirehouses have this covered. They have every scenario under the sun in their risk disclosures. So the pure RIAs need to make sure that they're disclosing every potential risk that could occur, including some unprecedented market decline. So those are some of the things we're telling our clients right now. Open to questions if you have any. But hopefully that focuses you at least on that risk tolerance area as it pertains to business plans, and it helps you determine what model is best for you.
Thanks so much, Tanya. Oh, I didn't do that. It muted you. Sorry about that. You had 1 second. I don't.
Oh, there we go.
Yeah. Do you have a final comment or?
No, if anyone has any questions about this atmosphere, or the different models and the risks associated with them, I'm happy to answer.
Yeah, so Cami and Tanya, thanks so much. Those were wonderful. Oh, there's some lag and somehow I talk over. Okay, I'll try to work on that. These are wonderful summaries, guys. Really, succinct. I thought they were awesome. They really covered a lot of things. So we have a couple questions. Let's launch into those. I'll try to give one to each one of you, and then we can have some other conversation after that. Tanya, one of our attendees asked, if you don't provide investment management / supervision, just advice, does that reduce your overall risk? I would equate this to what I was when I was with my independent broker dealer. My RIA was planning only, not investment management. So if you could talk to that.
Yeah, so with the planning only, usually you see the risk is more limited in that aspect. The SEC rules just generally are more limited as far as compliance. And so when you're only an SEC registered or say state registered investment advisor, there are a lot less compliance rules to follow. So yeah, the risk would be less. Oh, you're muted.
You're muted.
Oh, okay. Yeah, there's a little lag here. I'm not working well within. Okay, I'll keep everyone unmuted, and the three of us will stay there. Tammy, I think you saw the question from Christian, right? I think he asked.
Yep.
Let me try to find it. Okay, if you can answer that question, maybe repeat it, then answer it.
Perfect. And just building on what Tanya just said about the difference between advice only and if you use a TAMP or the other. So I do think that's a really interesting model to look at pure independence, right? Because your risk is limited, your compliance is limited, and you can kind of capture more of that revenue. So I think that's a very interesting area. So Christian's question was, what is the average expense for outsourcing compliance for an RIA? And this one obviously is probably very important to understand, and it's kind of the classic, well, it depends. So there is a large range in terms of what that cost would be for outsourcing compliance, right? So what we help clients do is, as we go through their philosophy, their business mix, their product selection, all these things, we also help them put together a pro forma. And so we'll literally look and say where they are today versus in these different models in terms of what they're paying for payout, investment, direct expense, and technology, compliance, et cetera, all the way down to try to get to a net. So some of the things that impact that outsourcing compliance question, and there is a large range. First is how big and complex is the business in terms of number of people and staff. So if you're a solo advisor or partner, that's very different than if you have, 750 million or $1 billion of AUM and you employ 50 people. So that complexity. So I would think about that as a spectrum. If you're a solo advisor, and or maybe in a partnership and you have a support staff person, your business is pretty vanilla in terms of advice and product selection, investment product selection, it's going to be much cheaper. I think building on again what Tanya said about this, what I think is interesting is typically you have different types of people who help you. So you may have an attorney, but what's most common also is that you would pay and have like an operations compliance consultant on staff for you, basically, that you pay through a retainer. And so that also helps limit your costs. They're the body that really gets you up and going. You have an attorney review everything, but that operations compliance consultant can take the heavy burden of helping you make sure you have the right agreements, that you're following your protocols on a calendar. So I would think of them as kind of like an outsourced CCO. And then the attorneys really come in for the document review, missing any gaps, or if there's like a litigation or regulation. So in that, what I've seen is like for solo advisors, the cost is under $10,000 a year. And if you're maybe a handful of advisors, I think thinking about it as like about $25,000 to get documents drafted, et cetera. Those are just, again, if you have kind of a advice, simple vanilla business. So it can really be a point of leverage in terms of revenue. Then as you get larger, the question starts to become, when do you need that chief compliance officer in the firm, and also having the experts with you. And I think that is when you start to get a handful of advisors, maybe you're growing junior advisors, things get a little bit more complex.
And just to add to what Cami said, what we see a lot is advisors chinsing on their compliance consultants, for lack of a better term. And what they'll do is they'll hire one of these big compliance consultant companies where you're not getting individual attention on your particular business. You get a canned compliance manual, you get a canned ADV, you don't know better, so you file it, you keep it in your records. A regulator comes by and they have said over and over again, if you're not tailoring your compliance functions to your business, you might as well not even have them. So it doesn't matter that you have something in your file drawer that's called a compliance manual. If it does not pertain to your particular business and it has sections in it that do not apply to you, it's as good as having nothing. So we always recommend, if you are going to use one of these bigger companies, that you pay for the extra services of the tailoring of the materials to your particular business, and that you pay them the hourly. It's usually an hourly fee to sit down with them and talk to them about your business. We also recommend a lot of these independent consultants that basically know their clients inside and out. We tend to like those better, even though there are good people at the big compliance companies as well. But you want to make sure that you're getting individual attention. And if that means you need to pay for it, then you should do it.
Tanya and Cami, yeah, I'll reiterate exactly what you guys are talking about. I've exactly gone through this. And it's so important, and it's really eye-opening. Exactly like you say, like when you're at an independent broker dealer, they tell you the compliance, read the compliance manual. You're like, oh, whatever, they're just telling me what to do. But now when you're your own RIA, you have to create your own compliance manual. You have to go through it. You have to read it. You have to actually ensure that what you say you're actually doing. So I've gone this through about 3 times with my compliance consultant, which has been great. It's been great. I've been learning a lot. Yes, it could feel overwhelming, but it's vital, and it's made me better because I'm truly now, I've thought about it, and I've set up, I have these systems in place. I know what I'm going to do for all these situations. And what was so eye-opening to me this entire process, these compliance consultants, when you're in my other world, like this IBD world, that's your broker dealer. But when you go this other direction, there are so many great people out there willing to help you. Like you say, these small ones, there's tons of them out there, and they're wonderful. So that was really, when I found that they existed, it really made me comfortable. I have the legal background, but that's going through it and working with them. It's been everything. Tanya, you mentioned that the IBD is the most wishy-washy. Can we figure out what risk we may inadvertently have exposure to?
Yeah, so I think the most important thing about being with an IBD or some sort of hybrid of that, there's various different models in the IBD world, is to look at your agreement with them. Your agreement is really boring to read, may be confusing. You may need to consult with someone about that agreement, but your agreement will really detail the risks associated with your affiliation with those IBDs. Now, of course, and I say that it's wishy-washy because we've seen all sorts of agreements. We've seen where liability is 100% on the FA, despite what happens either with their back office or yours. And we've seen where IBDs will completely indemnify the FA in the agreement, and no matter what happens, they have your back. So that's what really controls there. If you haven't read your agreement or you don't know where it is, now's the time to have that in your pocket, especially if you're considering making a move, whether it be tomorrow or a year from now. The last thing you want to do is ask your affiliate or whoever you're working with for your agreement the night before you're going to be moving firms. You want to do it, make sure you have it on file somewhere. You're muted.
He's on mute.
Yep. I'm mute. Okay, that's wonderful, Tanya. So we're coming up about on an hour, and this was great. And I think, as Cammie and I have discussed, I know there can be, I see about 2 more of these webinars already. Number 1, we'll get a compliance consultant on board, and really, for those interested, to really start walking through, what does that mean? What does it mean going through my compliance manual? Kind of go through that process, and kind of we can introduce people like that. And then Cammie mentioned real briefly, Tanya mentioned, real brief, we mentioned about the largest liability is on investment management. And not only just what you buy and sell, but on your processes and whether you have custody and the like. And so I personally do 100% outsource investment management through my turnkey asset management provider, whatever it might call. A lot of other RIAs do it 100% by themselves. And so I definitely see that's a whole nother webinar for us to have, just having those two, talk about it, compare, and it's really, what they would be comfortable, what they're comfortable in, like, Tanya mentioned their risk level. So if you guys want to, I don't know that we have any other questions here, but I know we could do, many, many more. I don't know if you want to share, well, we have your guys' information. I think
I don't want to interrupt, but there is one more question here that we didn't get to.
Oh, okay.
From Christian. It says, Tanya, what do you mean by having clients with margin appropriately coded? Having their accounts appropriately coded as far as investment objective and risk tolerance. So we have seen that, there'll be, for instance, a margin account where they're buying A-rated municipal bonds on margin and the account's coded conservative. But now we're seeing that because of the drastic market decline, that those people got blown out of their positions. So was conservative really the appropriate risk tolerance, even though it was a full fixed income account? Did the margin kind of escalate the risk, and it maybe should have been coded aggressive? So that's what I mean there.
Great. Awesome. And so, yeah, if you guys want to make any final comments here, and we'll wrap up, maybe share your information. How can they get in touch with you? Cammie, we'll start with you. One final comment, and then Tanya.
Yeah, Tanya, this has been, and Steve, thank you so much. And Tanya, great insights. I think one of the things that I've noticed is we've talked a lot about the business models and risk. And so I guess my point and kind of question that I would ponder if I were an advisor is, you always want to be compensated for the risk. So aligning those two things is important. And so I think understanding what the pricing is today versus what you're paying for everything, all the way down, versus the pricing later, and actually putting dollar costs to these things is one of the key elements of due diligence that would be important to know. Okay, we've talked a lot about risk, but what does that mean in terms of actual dollars I'm paying, and what that is or not? And I think that's really what's exciting about when you go from, least independence towards more independence, and knowing where you are on that spectrum, how you want to play the dollars. Because I think, like an insurance policy that maybe a lot of us who have really great businesses surrounded by, planning and great processes, client-centric, we're maybe overpaying for some of that. And there's ways, as Tanya's talked about, to mitigate those risks when you get your experts and your team aligned around you. So that's the point that I wanted to share. And thank you so much. We'll pass around the slides that I had if we haven't already, because I know some people have asked for those. And if you have any questions on there, my email will be on there, or you can find me on LinkedIn.
Awesome. Tanya?
Steve, is there any way you can share with the group my contact information so I can spelling my last name, or do you want me to just provided here?
Maybe provided. I wanted to share that. I mean, I could screen share maybe your website or your LinkedIn. I think LinkedIn's a great way to connect. That's how we met.
Yeah. So, well, our website is bressler.com, BRESSLER. You can find me on there with all my contact information. Again, Tanya Lambrechts. My last name LAMBRECHTS. Final comments. We are happy to speak to any advisor. We don't, as attorneys, we really consult with consultants as well when it comes to what's the appropriate model for you. Cami has a lot of insight into that. We really do kind of the paperwork aspect of it. A lot of our advisors want us to do the compliance aspect of their business. And while we have handled some of those things, it is definitely most cost effective to use a compliance consultant for that. So we always advise our clients on compliance consultants that we use and refer them out. And if you don't have a good one, feel free to reach out to me. I'm happy to provide some resources. Yeah, if you have, like Cami said, it's all a risk versus return business when it comes to your choosing your business model, and you just have to make that determination for yourself. So happy to talk to anyone in more detail about those risks from the litigation side.
Awesome, Tanya. Thanks so much. And if anybody here, if you're not a member of the FPA, we hope you would consider go to fpamiami.com and become a member, because we'll have this webinar posted up there, and we have many more coming. And I know we already have a few more that came straight out of this. So thank you everyone for attending. I really appreciate your time. Tanya and Cami, thanks a lot, guys, and everyone have a great day.
You too. Thanks, Steve.
Thanks, everyone. Have a great day.